Welcome to Windows Academy people. So today we can talk about one important aspect that you people actually wanted to understand, and I'll be starting from the very basic of it. So we're gonna study today stock market listings, how companies get listed in stock market, and it is the part one. I'll be covering small concepts about why a company gets listed on stock market. So we're gonna start with the very basic question that what companies do. So each one of us knows that companies have different projects. They do something, they want to generate income and revenue, so that they do different projects. Now sometimes when a company is thinking of starting a new project, and at that time they are short of funds, and the company is thinking that they will be able to make a lot of money from this project, and that time they think, what if we just get or raise funds from somewhere? And that is where the major question comes to the mind of people or the management of the company, that how do we raise these funds? In simple finance, we can say there are only two ways to raise funds. One is through debt, or you can also say by taking a loan. And the second one is equity. At this point of time, I believe everyone and each one of you knows what is debt or loan. In simple terms, debt or loan is you take money from the bank or any institution and you tell them, okay, we are providing you interest payments every single year, and by the end of the tenure, that something that we have signed on the contract, we'll be providing you with the principal back. That is debt. But the problem with debt is it becomes quite risky, because there will be contingency in the project as well. You don't know whether you'll be making a lot of money in the first 2 years or not. If you're not able to make money, how will you be able to provide that interest rate? How will you be able to provide that interest? And that's where equity comes into play. Now the second question that we have is, what actually is equity? So in simple terms, if I have to explain equity, I would say equity is nothing but share of a company. Now, at this point, I'm not saying that share of a company which is getting listed, which is getting traded on the stock market. I'm talking about that part of the company, that share, the small share of the company. Now, this share, if I say, could be 5% share of the company, it could be 20%, it could be 50%. And if you're holding the 100% share of the company, that means you're the promoter or you're the person who actually the founder, you can say. Now, what people think, or what management thinks at this point in time, if we need to share our company, why don't we do that for funds? So what companies do whenever they're short of funds and they want to raise money for a project, they go to investors and tell them, you can buy 10, 20 or whatever percent stake in a company, and you will have to pay this much amount of money, let's say 200 crores for this 10, 20, 10% stake. And in next 5 years, we can say that you will be able to make, let's say, 200% profit. That's what happens in Silicon Valley. You go to Silicon Valley and you ask them out, they will say, okay, we want 300% profit in next 5 years. And that's how it goes in Silicon Valley. But in simple terms, what these management companies say, what the manager of the company says, you provide us 200 crores today, and we will be providing you something in return. So let's say if this is worth 200 crores and this is a 10% stake. Now, what is the value of the company? If I say, if 10% value of a company is worth 200 crores, the actual valuation of the company is 2000 crores. Now, if the valuation of the company is 2000 crores at this point of time, and they're taking 200 crores as simply funds to do some project. In next 5 years, if they keep on doing things and they do the right things, they're able to generate revenue, they're able to do things and able to get the brand value and generate income, revenue, every single thing in the right manner. What if the new valuation of the company becomes 5,000 crores? So now this investor who bought just 10% stake in the company for 200 crores is enjoying 300 crore rupees of crore rupees worth of profits. And this is the idea behind equity. Now, this is the very simple way in saying that this was you provided share to a person or an investor. But how does it happen in publicly traded companies? Now, just think of it. An investor can, a company can provide different stakes to different investors. But a time comes when company thinks we need so much of funds that not one investor, not one player can provide us that much of amount of money. And that is the time when they enter stock exchange. So these companies, when they're trying to do a project or when they're trying to expand and they want huge sums of money, which they know a single investor would not be able to provide, or a syndicate won't be willing to provide, at that time they come into play and they start going to get listed on stock market. And after a company gets listed on stock market, we call it, it is now publicly traded company. Although something which I explained in the last 2 or 3 minutes are applicable for an investor who's trying to buy shares of a publicly traded company. It goes in the same manner. What you're doing, let's say a stock price of ABC company is at 100 rupees right now, and you're seeing the news, you're reading reports, and you're like trying to understand and reading all the, you were analyzing all the AGMs, and then you read all the annual reports of the last 5 years, and then you were able to understand, okay, this company is trying to expand in this industry. And I believe the net cash flows they have, if we project them and we do a valuation, I believe this company would be able to do a lot better in the next 5 years. So you buy this company. After buying this company, in next 3 years, the company performs according to you only, and company makes good profits and the valuation increases. Now, the percentage of shares that you bought, which were available on the market, let's say, on that basis only your wealth will increase. So mathematical calculation I won't be doing right now at this point of time. Although if you want to learn that, you can always join the group. I have given that link in the description of this video. You can join you can join the link, and I keep on providing people with information how to do that DCF and how to value a company specifically. So you can learn that mathematical calculation there. But at this point, I'm just giving a simple rough example. So let's say in next 3 years, the share goes to 230 rupees. So how much you have earned? You have earned 130 rupees worth of profit for one share. Now, how did this happen? This happened because you were able to understand what kind of project they're doing, what kind of expansion they're thinking to achieve, and what they're viable to achieve that. And that's why you invest money in a certain company. Now, this was the basic theme why companies get listed on stock market. There's only one reason, one major reason. They want to get funds. And once they get listed on stock market, then the stocks and shares are just being like traded. I'll give you a very fine example before ending this video. And it is, a company was listed on stock market, let's say in 2001, and the the let's say the amount of share, the stake of shares which is publicly traded is just 20%. That means 80% of the shares of the company are still now not publicly traded. They're into the private, like with promoters or with we can say other investors or venture capitalists, anything, anyone. But what do we understand from this? 20% shares of the company are publicly traded. Now, if these 20% shares are publicly traded, and I bought those shares in 2001 and I sold them in 2002, so I won't be selling them back to the company. I will be selling those shares to someone who's a market participant who will be buying shares from me in National Stock Exchange itself. That means the 20% stake of the shares of the company keeps revolving around in the stock market. There are not new shares being built up until unless there's some restructuring happening in the company. So this is how the whole system goes. I believe you were able to understand things. And if you were not, you had any problem, you can comment in the comment section. You can join the group and you can message me personally on that group. I will be able to resolve the problem accordingly and as much as I can do. So this was all about today, and we'll be meeting in the next video where I'll be talking about how companies get listed on stock exchange. Today I talked about why they get listed on stock exchange. In the next video, I'll be talking about how do they get listed on stock exchange. So this was it. Thank you for watching the video, and bye bye.